Payday finally arrives, but before any sense of relief sets in, a credit card bill notification appears, making it feel like a month of work led right back to the same place. You open your banking app and notice the debt balance is slightly lower than last month, yet something about the numbers feels strangely off. Hundreds of dollars are being paid every month with steady discipline, yet the total debt still appears almost unchanged. Many people assume the problem is simply earning too little, when the real issue is often hidden somewhere else entirely. In 2026, credit card interest rates in America have reached levels that leave many households struggling under the weight of everyday finances. What makes the situation dangerous is that the trap looks completely normal until someone calculates how much money has quietly disappeared. Welcome to The Margin, where we examine modern life through money, work, debt, and economic realities that are often uncomfortable to confront. Today we are looking at how millions of Americans became trapped in credit card debt cycles and the methods they have used to break away from them. For years, credit cards have been marketed as a convenience tool, but many people quietly end up buying extra time at a surprisingly expensive price. As inflation pushes everyday expenses higher, credit cards often become a temporary cushion that can slowly turn into a lasting burden. One small purchase rarely feels dangerous, yet dozens of small purchases collecting interest each month tell a very different story. Many professionals are not carrying debt because they spend recklessly, but because living costs are moving faster than their income. That distinction matters because debt does not always begin with irresponsible decisions. Sometimes people are simply trying to handle medical bills, rent payments, or unexpected car repairs, while interest keeps accumulating regardless of the reason. This is where debt stress can emerge, turning money concerns into something that quietly occupies mental space throughout the day. Ironically, financial stress often makes financial decisions harder, allowing the cycle to continue repeating itself. The deeper issue is not just the debt itself, but the way interest slows down a person's ability to move forward. When interest works harder than the person carrying the balance, even small steps forward can feel like moving against the current. The most expensive part of a credit card is often not the card itself, but the minimum payment attached to it. Many people treat the minimum payment as a safe option, even though it often keeps debt active for much longer. Imagine carrying $5,000 of credit card debt at a 25% APR, where the real story begins with time. When only the minimum is paid each month, most of the money goes toward interest while the balance barely changes. A $5,000 balance can quietly turn into a multi-year journey with a much larger total cost. What many people miss is that making payments and reducing financial risk are not always the same thing. Each monthly payment can feel productive, even when the underlying progress remains mathematically small. This is less about personal failure and more about how compounding works when interest moves in the opposite direction. Compounding is often associated with investing, but the same mechanism can also amplify debt over time. Once compounding begins working for interest instead of you, time gradually becomes the most expensive variable in the equation. The first strategy is called Debt Avalanche, a method often viewed as the most mathematically efficient way to approach multiple debts. The core idea is simple: direct your main focus toward the debt carrying the highest interest rate. At the same time, every other balance receives only the minimum payment while extra money goes toward the primary target. By reducing high-interest balances first, this approach typically lowers the total interest paid over time. A financial analyst in Texas once described shifting attention from 4 cards to a single high-interest card and tracking the difference over several years. Experiences like this are often cited as examples of how mathematical efficiency can change the pace of debt reduction. The challenge is that the first visible win may take longer to appear than some people expect. Not everyone feels comfortable waiting for results that sit farther out on the time horizon. After all, people do not make decisions using spreadsheets alone, and emotions often remain part of the process. That tension between mathematical efficiency and human behavior leads directly into the next approach. Debt Snowball follows a different logic, focusing more on psychological momentum than mathematical efficiency. Instead of targeting the highest interest rate first, the approach starts by paying off the smallest balance. As one debt disappears, confidence begins to build in ways that are not immediately obvious. Dave Ramsey popularized the method because he believed lasting behavior changes often begin with small wins. A school teacher in Ohio paid off 3 small credit cards within the first few months and experienced a different sense of control. Mathematically, the method is not always the most efficient path available, even when it remains popular. For many people, the experience highlights how financial behavior can matter more than theoretical optimization. A perfect plan that never gets used remains inactive, while a simpler plan can continue moving forward. The discussion often shifts from finding the best method to identifying which method someone will actually follow. The answer varies from person to person, which is why the method produces different reactions for different situations. Paying down debt without stopping new debt is like bailing water from a boat that still has a leak. That is why many experts suggest taking a temporary break from credit card use until conditions become more stable. Some people jokingly call it plastic surgery because the habit changes even though the card stays the same. One person kept a credit card in a drawer for an entire year, and that simple decision helped interrupt an old pattern. Surprisingly, the problem is often not the card itself, but how easily it can be used. When a little friction is added to the buying process, impulsive spending often becomes less frequent. The next step often involves building a small emergency fund, because even $1,000 can make a noticeable difference. Without an emergency fund, every unexpected problem can turn into another round of debt. Many people want to attack debt aggressively right away, even when the underlying foundation remains fragile. Sometimes the most productive move is not moving faster, but reducing the chance of slipping backward again. Many people assume credit card interest rates are fixed, even though they can sometimes be negotiated under certain circumstances. From a business perspective, lenders often prefer receiving smaller payments rather than receiving nothing at all. Hardship programs remain available at many financial institutions, although not every customer knows they exist. A single phone call may not remove debt, but it can sometimes reduce the weight of interest costs. Another option involves balance transfers with lower promotional rates, although the tool requires careful handling. Moving debt without changing behavior simply relocates the problem instead of removing it. Many financial strategies struggle because attention stays on the tool while habits remain unchanged. Even a useful tool can produce poor results when it is used in the wrong way. Changes in behavior and changes in strategy often need to move together rather than separately. When those two elements finally meet, the possibility of leaving debt behind begins to look more realistic. The path out of credit card debt can be summarized through a simple framework called the Freedom Recovery Loop. The first step is creating a small emergency buffer that provides a little room to breathe when unexpected expenses appear. The second step is stopping new debt because an ongoing leak makes every repayment effort harder to sustain. The third step is choosing a repayment strategy that matches your personality, whether Avalanche or Snowball. The fourth step is reducing interest costs wherever possible because even a small percentage can change the math. The fifth step is building financial margin because a little extra space often changes how pressure feels. At that stage, money begins serving current priorities again instead of being tied mostly to past spending decisions. This is the real transition, moving from survival mode toward the process of building a future. Financial freedom rarely comes from one dramatic choice and is more often associated with many small consistent decisions over time. The first decision in that process can begin today without waiting for ideal circumstances to arrive. If you're dealing with credit card debt right now, it's worth remembering that many others are facing the same challenge. Across the modern economy, millions of people are navigating similar financial pressure while searching for a way forward. Debt can feel heavy in the present, but today's situation does not automatically define every future chapter. Sometimes a major turning point begins with a decision so small that it barely seems important at first. The comparison that matters least is how fast someone else moves compared with the direction you choose for yourself. In the end, financial freedom is often discussed as numbers. even though it is closely connected to having more choices in everyday life. If discussions like this resonate with you, consider subscribing to The Margin for more stories about money, work, and modern life. Which approach are you using to tackle debt this year? Snowball or Avalanche?